afternoon, everyone. Hello and good afternoon, everyone. And thank you for joining us for the third in the five-part series presented by Mass Mutual. This is Piggy Banks to College Funds, and we are focusing today for our Lunch and Learn on financial college planning. A little introduction to our statewide family engagement team. My name is Kim Rivers, and I am the training coordinator for our family engagement team. And I'm going to pass it over to Jeanette.
Good afternoon, everyone, and welcome. I'm Jeanette Mejias. I'm the co-director. You can see our team members are listed here, and we'll put our website link in the chat so you can read their fantastic bios. But I'm very proud to work alongside such an incredible team. Back over to you, Kim.
Thank you, Jeanette. And so now we're going to talk about our project, our Family Engagement Hub project. We are all about uniting and creating partnerships and collaborations between families, educators, and communities. So we do a lot with our school districts. We are a centralized hub. We provide all of these wonderful webinars and workshops that are happening every month. And we also work with a variety of partners presenting a lot of really great information topics that help families, educators, and communities serve our student populations best. So now I'm going to pass it over to Christina to move forward with today's presentation.
Awesome. Thank you, Kim, and thank you for the team for having us yet again. It's been a great experience working with all of you. Um, Always the fun disclosure. All this is saying is, again, this is general advice. We're trying to provide overall education, but this isn't specific advice, whether it's related to tax or legal to your situation. We'll get into how we can meet one-on-one if needed and get into that. But for this, again, it's overall general advice, not specific to your situation. It's always everyone's favorite slide. Um, who the heck am I? So, as they mentioned, I'm Tina Zappi. If you haven't been on the previous workshops or you have, I'm over at Mass Mutual in Warren, New Jersey, and we're local. We cover the state in general, and I'm a financial advisor over there. And again, if you have any specific questions, contact info is there. So we start with this slide with every one of our five-part series because the overall goal on why Mass Mutual, we don't just work one-on-one, but we partner with organizations like the NJFE, SPAN, all these different organizations throughout New Jersey is we're trying to touch and educate as many people to assist them in achieving what we call financial well-being. And what does that mean? So first and foremost, it references having control over your day-to-day or your month-to-month finances, knowing what's coming in, what's coming out, and what exactly how you're utilizing that in and out to achieve those goals moving forward. Two, having the capacity to absorb a financial shock. So what does that mean? We've seen a lot of volatility over the past couple years. In reference, it just means in your financial landscape, the way that you have your buckets of savings set up or whatever it may be, if the market were to be volatile in the negative or positive, you still can go on throughout your day-to-day life, knowing that you had a plan in place for either or situation. So being able to deal with that volatility per se. Three, being on track to meet financial goals. As Kim mentioned, today is about college. That's a huge milestone, whether you're a parent or a child or however you're splitting that responsibility that a lot of people have on the horizon as a financial milestone or goal they're trying to achieve to pay X amount, whatever that may be. How do we create those goals? How do we ensure that we're on track? That's all about in financial well-being that we have those goals set up and we have a way to measure and track our progress towards them. Lastly, I always joke the term financial freedom, having the financial freedom to make choices that allow one to enjoy life. This means a lot of different things to a lot of different people. How we define this as the financial advisors is whether you do or don't. Some people want to retire, some people don't. Some people want to keep with their job, some people don't. I could go on and on, but all this means is you have the ability with your savings, investments, whatever your financial landscape looks like, to live off of what your assets would generate. So when we say financial freedom, it's the freedom from needing additional income. Whether you continue to make that, whatever you do for it with it is up to you, but it's the idea of having that ability. So, what are we going to talk about today? I think college can be a very overwhelming topic, but a lot of the times, and this goes with all financial literacy topics, it's more so that we don't hop in and educate and create those plans or goals to make it seem more manageable than not. A lot of times, college is something on the Thanksgiving dinner table or whatever holiday we all celebrate. Families are talking about how expensive it's gotten, and and we'll get into how it's been growing from a cost perspective, but we really want to start to understand what this means and what actions we can take today and in the future to put ourselves in a better position, our families in a better position for college. So first, I kind of alluded to it, understanding college costs. What goes in to when we talk about college is expensive? What makes that up and what are some things we can do ahead of time and while we're in it to, really be able to grasp and get ahead of the costs themselves. How can I fund college? I have a lot of people come to me depending on their children's situation. How about if they don't go to college? All these things on why they're not sure when they should start and how. So we're going to talk about the different options we all have access to get ahead when it comes to planning for college. Three, financial aid. We always say as professionals, the best type of money that you use to pay for things is other people's money. So, how do we know where we land on that standpoint? What is used to judge whether we're eligible? And either way, no matter where we fall, how can we prepare moving forward? And then there's a couple other topics that we'll dive into that go into this overarching topic. First, this is kind of what I alluded to as that family dinner, what we all joke about. College is getting more expensive. And don't come for the messenger, but I think it's important to acknowledge that college is a business. Some people sometimes misinterpret where that's really the driving factor of all of this. They're all businesses and they're looking to not necessarily take advantage, but they have to make profit just like any other business that you come in contact with or you encounter. So it's important to see, and this is a good kind of illustration on how it's increased. Over 20 years, how has college increased? And on the private side, over 20 years, it's increased 40% in terms of price. Public, which think your Rutgers or your state schools, has increased a little over 30%. When we look at costs, what we're looking at is yes, tuition. There's a lot of fees like technology fees and multiple things that will get tacked onto that cost. And room and board, depending on where you're going and where you're planning on sitting while you're going through this education. Why we bring this up is not necessarily that we want to continue the narrative where college is expensive, throw your hands up, and that's all we can do. I think the idea, and you'll see this theme throughout all of our workshops, is we want to add context to the topic or situation we're discussing, but understand that with anything, with a plan, and again, something you can measure against, all of this becomes that much more manageable. So now we're going to look at average in terms of average tuition from last year, the cost for 1 year of school. So it's important to note that not only, and I don't want to harp on it getting more expensive, yes, the cost of college can increase year by year, but also looking at our different options and where that might land. So, and again, on average, New Jersey, you may see sit higher than some of these numbers. This is more national, but a public 4 year in-state tuition for 1 year, it's close to 12. You'll see the tuition drops a lot when you're in-state, along with room and board, and some of those things, those costs can lower depending on the situation. We're right around 30,000 a year for a public 4 year out-of-state school. So for us, and I know myself, like a Penn State or any of those big schools that you hear outside of Jersey, those are the schools that they're mentioning. And then the last one, private 4 years. So you don't necessarily even have the option for in-state tuition. It's coming just under $50,000. So that would be, you can look at a Quinnipiac or anything where it's not necessarily a state school. So we're not really concerned with what state is it sitting in. It's just labeled as private. So when we look at when we want to plan, and this is something that I know a lot of people on my team, we have two team members who have a 12-month-old and an 8-month-old, projecting out college costs. And again, this is kind of like the last theme on harping on this, but when we're planning with anything, you heard about it when I talked about when we're planning with retirement, if we're making, say, $70,000 this year, if we're retiring in 30 years, having enough assets to generate just my income now is not going to make up for the inflation difference. Meaning, if I make $70,000 now, as say a 30-year-old, the amount of income I'll need at the age of 65 to retire is going to be a lot higher because life continues to get more expensive via inflation, etc. Same goes with college. So when we're looking at the cost of college and what we're exactly planning for, we want to identify the costs of, XYZ college. And you don't necessarily need, I help families plan from when they have 1 year olds to when they're a year out of college. You don't need the exact colleges to really start creating these goals, but it's important to add context to what you're doing. So look at maybe a Rutgers or one of the local schools that's close by, and you can use that tuition somewhat as a benchmark of, okay, if this is where it's at now, say my child is 1, they're 10, they're 16. If I project it out to X amount of years, what is that cost going to look like? Because we really want to track where we're going at the moment of time of when we're going to need X amount of money or whatever it may be. So we don't want with a, say, toddler to track, okay, we need to save enough. Say we want to help with half of if they go to Rutgers, we need to save now. It's no. When they get to the age of 18, what is that cost going to look like for 2 years? So it's all, again, making sure that when you're making these goals and looking at how you're going to save, that you're putting it into future value dollars. So, how do we look at funding college? Again, this isn't necessarily a hard and fast rule on how to do it, but we like to give general ideas or really concepts that you can take from today to start putting together, like, how do you start to chew off these larger financial milestones. So we say when you're looking at a funding strategy, look at a third in savings, so kind of like pass, a third in income now, a third in loans. So it's not that you need to use this breakdown, but it's saying that a great, when we look at how loans are impacting those in the future and all of that, a great goal to have is I can cover a third of whatever that tuition is in savings. So that's money that you put aside in the past. So I can cover a third of whatever that college cost looks like with savings. I can cover a third right now with my income. So that means whatever income you're bringing in, say you can, you peel off a certain amount and that goes to a third of the college cost, and then a third in loans. Again, a third and third, a third is not how you want to do it. I think this is also to give all of you an idea of how can I think about this. So one, you can use savings. That's okay. Your child's not getting into college right at this moment. Again, they're 1, they're 5, they're 10, even 16. There's vehicles that you can put money in now that'll act as that past money, the buckets of savings that you can use by the time they get to college to pay for a portion of the tuition. So it's showing that that money that you put away in the past will cover X amount of that college cost. Then now, when I look at my income, my cash flow at my current basis in and out, say I'm able to save, 1,000 a month or whatever it may be, I can pull off X amount of whatever my surplus is or savings and put that to the college cost right now. So it's the idea of not just using your savings, but having a plan for your income now where you have inventory on what's coming in and out and you can allocate some of that to the current cost. And then third, loans. I know sometimes people, again, just with college, have a negative connotation when it comes to loans. We're big believers as financial advisors, and we went over it in our past couple of workshops. Not all debt is bad debt. There's just important things when it comes to college. One, you need to have a plan. And two, and I'll talk about this and when we meet with people, some of the things or context we can bring to you is it's understanding what you can afford. Because when we look at loans, let's think mortgage. When you're taking a mortgage, you have to go to a lender and they tell you based off of your income and assets, you can afford X amount. We don't really have the same guidelines when it comes to college. So it's important to meet with someone or do your own due diligence to see based off of your income and assets what costs are you going to be on the hook for when we look at financial and merit aid and all of that. How much am I going to be responsible for, and based off of my income, how many loans can I really take out? Because There's, again, there are still regulations around the loans you can take out, but without having a plan like this, where you're saying, I know whether it's a third or whatever percentage loans are going to cover that amount, you can really get yourself in a situation where you maybe took out too much and now it's hurting your own financial goals or retirement, or putting your child or whatever family member you're helping support in a situation where they can't really climb out of it following college. And I touched on some of the things you can do. So when we're talking about savings, again, this is past money. So what that means is, what can I do now if we're not looking at the college bill tomorrow? That means, over, if I have years of saving, what are some vehicles I can utilize? And there's a bunch of different ones. It depends on the state and where you are. I think 529 college saving plans are one of the most known options out there. And 529s, why they're so powerful, why people open them up, is when you have a child or a family member that is leading up to college, you get to, it's very tax efficient in three ways. One, you can get a deduction depending on your income for putting money into that. So when you do your tax refund, like some of us are doing right now, coming up on April, you can get a deduction for some of the money you put on there, depending on where you fall income wise. Two, it grows tax free. So say you have 10,000 sitting in your 529 and it's growing with investments. The growth that you experience on those investments or savings are not being taxed, which is great. And then three, when you pull that money out, so say you pull it out of whatever investments or vehicle you have it in, you're not paying taxes on the growth, or quote unquote, when you sell and take that money out to use it for education based expenses. So it's one of the few accounts that we have access to as people, like in the United States or whatever it may be, where we're experiencing tax efficiencies in three manners. So that's why you see a lot of people open these up and use these for college savings. Again, you're going to want to balance it to your overall family goals, and I'm happy to, discuss what that might look like for you. You don't want to put too much money in here. You want to make sure you're putting your oxygen mask on and hitting your goals, because this does have to be used for specific reasons related to education. But they're really powerful, and they do have some flexibilities if your child doesn't end up going to school, and say you have a sibling, or there's some other ways to take the money out of there. There's two other things we have here. Second is the Coverdell account. Long story short, it acts very similar to 529, but it has a $2,000 limit. And you can usually use it for earlier education if private school or those types of expenses are going to be something that you're funding earlier in the child or family members' lives. So we see a little more flexibility with the 529, in terms of there's not that lower limit of, you can put a lot more than $2,000 into that type of vehicle in the 529. The Coverdell, the limit per year is $2,000. There's some other differences between the two, which I'm happy to discuss afterwards, but when you're thinking of the two, that's kind of the main two factors I pointed out. And then three, as much as these accounts are great, there's plenty of savings and investing accounts that you can open up yourself or the individual going to school to start to save, but prior to college. It's not that you need to use these educational related vehicles to save. It's just, as I mentioned, there's a lot of benefits in doing so. So hopping a little more into the 529, because this is one of the more prevalent ways that people will start to save for their family members ahead of time. The tax advantage side of it, I know I got into it, but again, it's going to be one of the first of the three, one of the one accounts where you get three ways of tax efficiency. You can get the tax deduction for putting money in, it's going to grow tax free, and you can pull it out tax free. Um, Two, as I mentioned, though, one of the limitations is a lot of times it has to be used to pay for higher education costs. So say your child doesn't go, or family member doesn't go to college, sometimes there can be limitations on how you can utilize those dollars. That's why I always say it's important when we talk to families, we'll really look at the overall landscape of, how many siblings you have, because there's some things you can do to maybe transferring it to a younger sibling, or there are ways you can pull some of the funds out. So it's just important to have a clear plan of the money that you put in here, knowing your past, depending on, what that family member decides to do down the road. Lastly, Each state has their own. You can use, whichever one you'd like. Some have different advantages than others. I can't really dive into each state again, or each individual situation. A lot of people in Jersey will use New Jersey's, and sometimes if you don't use your own states where you live, the tax deduction you might not get when you put money in. So long story short, I just encourage, if whether you're looking to open a 529 New Jersey's version or any other states, familiarize yourselves with the regulations, and if you have questions on that, I'm happy to help on that end. And then a little more on here and how to utilize them. One, as I mentioned, the earnings and the distributions, not just the money that you put in, are tax advantage. So that's, you're gonna hear it, taxes, 529s tied together, but it's really important to nail that theme home. Two, anyone can establish them. So you can have, like a grandparent do so, a secondary family member. So it doesn't just have to be parent for child. It's important, if you have someone in the family that's looking to help support whatever it may be, you have options there. And then, yeah, when it looks at taxes, the money you are put in here are looked at gifts. There's some limits on how much of gift you can give per year, how much you can put in 529s per year. I just encourage you, want to again look up the regulations, look at your income and your own situation to determine what that regulation is for you. Now you'll see here, and I've been touching on this, you do have to utilize it for educational related expenses, or there may be taxes and penalties. Taxes and penalties that can make people nervous. You still get whatever money you put in, nothing like your own money that you put in there. So if I put $1,000 in and it grows to 2,000, the original 1,000 is not going to experience any penalties or taxes. It's that growth that could possibly experience either or. It's going to depend on the expense or reason why you're pulling it out. There's a couple things to it. So it's just important, again, if you have a unique situation, I'm happy to talk through it, whatever it may be. And the last one is what I alluded to. You may switch the beneficiary to another family member. So, say for my family, for example, I was the older sister, and then I have a younger sister named Shelly. If my parents opened a 529 for me, Tina, and I end up, going and pursuing a different future outside of college, so I can't necessarily use these funds, my parents would be able to make the beneficiary my sister Shelly. And there's no penalties, there's no taxes on that. So again, there's, I don't want to call them loopholes, but there's ways to utilize these funds if it's not directly for the person you opened it up for the college expenses. So it's just important to look at your situation. And again, if you have questions, I'm happy to answer because I know it can get convoluted depending on your family situation. So one of the two differences that I talked about with the Coverdell, it's not as familiar of a college saving tool as a 529, but it definitely can be powerful. One, it can be tax advantage. It's similar to the 529. What I do want to point out is you'll see here in the second bullet, it could be used for younger related educational expenses. So if a lot of people will utilize them if your child or family member is going to private school or some educational related expense in an earlier age, but again, you're going to have that $2,000 mark on this type of account. And you'll see that here. So until the age of 18, again, you'll have that $2,000 mark. I did talk about the tax-free benefits, or not tax-free, but the tax efficiencies you're going to have here. You it does need to be post-tax contributions into this account. When you hear that term, post-tax contributions, that's money from your paycheck. So when you have that money come into your bank account or whatever it may be from your employer, you pay taxes on that. That means that money is post-tax, so you can utilize that for contributions here. Again, it's tax deferred growth, and then when you pull it out to use it for your educational related expenses, tax-free withdrawals. You have a similar ability where you can change it for the beneficiary to a different family member. So whoever the beneficiary is, that account has to be used for expenses related to that person's education, but you can change it to, it doesn't just have to be a sibling. There's all different options you have. You could give it to like a grandchild or whatever it may be. So again, you can transfer the beneficiary from family member to family member. And then when if you don't utilize whatever's in the fund or account until they're 30, it'll actually be transferred over to the beneficiary into their personal, call it, portfolio. So what that looks like, again, will depend on the state and the income you're at and why you're not utilizing these funds. I'm happy to talk through it because it really does depend person to person. But when we think about these two saving vehicles, they're great if you have years ahead. And people think sometimes, like, I have a child in high school or a family member in high school, it's too late. It's never too late. Even if they're in college, some people will open these up to use them to fund college because we have still 4 or 3, however many years to utilize the tax efficiencies and take advantage of, potential market growth depending on how we invest in here. So I always say, I think college is something that people don't start very early and they kind of chalk it up to, wherever they may land down the line. No matter where you are, even if someone's in college that you're helping support, I strongly suggest, whether you meet with someone or not, to create a plan and to still start saving goals because there's always still potential to take advantage of these accounts and others. So again, you don't just have to use these college savings vehicles. There are other vehicles that you can utilize to support these efforts, and you'll see a lot of them here. One may see obvious, but savings account. So savings accounts, CDs, money market accounts. This is a lot of common places where people will park cash or savings to maybe experience like slight interest growth compared to, nothing or lower than 1% in some savings accounts. So it's just like any other goal. It could be you could think of it like retirement, buying a house. It's another milestone that we're saving a bucket of money to utilize when we get to that time to, support or fund whatever part of tuition we're making our goals. So these vehicles that we're familiar with, and for those who are not, CDs and money market accounts are fixed income vehicles, which means that we earn anywhere usually between, I don't know, you could call it a 2 to 5% interest on the money that sits in them. It depends on the markets and interest rates on all of that. But we earn X percentage for leaving our money in these vehicles. So we can, the ones that we use to save for houses, retirement, can do the same for college. It's, there's all different vehicles that we can use for these goals. So it's important to note that. Two, investment accounts. As much as we talked about this in the prior series, they're more than liable or more than feasible to utilize if you want to take advantage of quote unquote that market growth and not just invest for retirement or these other goals. You can do the same thing for college. So as much as you can invest in those vehicles that I discussed, you can still invest outside of them in your own personal investment accounts and have your goals to pay again for XYZ amount of college. And then lastly, individual retirement accounts, IRAs, 401ks, I think 403bs for some of you in government related organizations. It depends on the expense. It depends on your plan. So again, this isn't general advice. We'd have to look at what your individual situation is. But nonetheless, you can, in some instances, utilize your retirement account, the funds in your retirement accounts, whether it be IRAs, 401ks, 403bs, etc., kind of the alphabet soup of retirement. There are instances where you can utilize the funds in there for college. I think what I want to drive home overall on this slide is college is just as much of a goal as anything else. There are different vehicles because of the nature of college where you might get more tax efficiencies than when you save for others. But overall, you have all these different options on how to go about it. It's really important to figure out what you're on the hook for college, based off of your current situation, what I'll get into down the line, and then creating goals utilizing these any of these vehicles I just reviewed, looking at the growth that they may yield and figuring out what efforts do I need to do now to build that pass bucket to fund part of college or whatever milestone we're working towards. So we talked about current income. This is going to go back to a lot of my second and first part of this series where we talk about when we talk about any goal, how do we start? We need to know what we're working with. We really can't work towards any goal without having a monthly inventory on what's coming in and out. Because if we don't know what money is sitting in our savings after each month or whatever period of time you want to look at, we don't know what amount of money we have to deploy to some of our goals. So I think it's really important when you're going to see this, and you'll continue to see it in all of our presentations, we need to look at our monthly budget and then we treat it as a regular expense. So it's similar to rent, your mortgage, etc. When college comes time, if you're looking to support a family member, whoever it may be, college tuition or a part of it might become a regular expense where monthly you're pulling out money, you're either putting it towards it or you're putting it in a separate account to earmark for whenever you need to pay that tuition bill. Um, there are different payment plans for each school depending on where you go. I'm happy to shed some light on that, but again, it's important to look at it, look at the time periods in which you can go about funding school. And then there may be some income tax credits based off of your situation with income and assets. I'll get into what we've done with some families to help them see what they're eligible for, but I like to use this presentation to make, I think not a lot of people are aware of all the other people's monies or cuts you may have access to depending on your situation. So I strongly encourage to look at if you are eligible, and you can look at your income level online and then see what you may qualify for based on your situation. Lastly, student loans. A lot of people are worried about them. They hear about different kinds and they think they have, more negative connotations or effects than others. I just want to make people aware of the different types of loans they may have access to. One are private loans. I strongly suggest, if you know, and this is kind of not to derail, but if you know anyone with private loans currently, maybe a great time to refinance because rates are coming down. But nonetheless, private loans are outside of the government. They're with private entities. And the interest rate will reflect, as you'll see in whether it be markets or whatever it may be. But again, whether it be through me and I have some contacts or others, I suggest looking at different private lenders or brokers right now. If you currently have private loans, because there may be a chance to refi into a lower rate. Nonetheless, private loans are a way, after you get past the federal limits, which depend on the situation, to take out loans to fund the additional part of school. So you have private loans and then government loans. Government loans are important. There's all different kinds. There's some you may be able to default to when you fill out FAFSA. There's additional ones, whether you're what school you're looking at and where you fall income wise. Again, and I'll get into FAFSA in a little bit here, and how you might be able to figure out what you're eligible for. But it's important to know the two different types of loans, especially when you're going to take them out and making a plan. You want to note the rates and where you're getting them and all of those things. Lastly, one that's overlooked a lot is permanent life insurance loans. This is one of the few vehicles that you can utilize and invest or save on yourself. So if you were to get a permanent insurance policy, without getting into it, and there's a second slide to go on to it, there is a cash value part to that type of vehicle. And long story short, the cash value is kind of like an additional, I don't want to say savings plan, but bucket of cash that you can tap into and take a loan against. And the rate isn't necessarily tied to the markets, but one that with whatever insurance company you purchase through would show you. But without rambling or getting too in the weeds, you can take loans out on your own insurance, which would then be another way to borrow against yourself or your policy to fund part of college. So it's important to note you have options when it comes to loans. And again, we'll get into how you figure out how much you're going to have to take out and all of that. So what's the difference between the two, private versus government? We can start on the private side first. Kind of within the name, it's going to be issued by a private company. One, two, it's going to most closely resemble a personal loan. So there's all different reasons why we may take out personal loans. The structure to it is going to resemble something similar to that. And then the eligibility and interest rate are going to be dependent on credit history along with some other things. So I don't want to say you get underwritten, but there is a approval process when you go through this to see the amount that you can take out and all of that. So there is a process that you'll go through similar to a personal loan when you're looking to take private out for the amount that you're taking, etc. Two, on the government side, there are government loans. What does this mean? The government loans are funded by the federal government, and They're applied via the FAFSA. So when you apply via FAFSA, they let you know what you're eligible for, and then you would move forward from there on if you wanted to utilize any of them. They do have or typically have lower interest rates and favorable repayment options. The reason why you're like, okay, Tina, if the government loans have this, why would I not only use that? There are limits usually into how much you'll get from a government loan, which is why a lot of people will start with the government loan to fund a certain part, and then the private loan they'll use for the remainder balance that maybe is not funded. All right. And then how can I fund college? I know this is kind of the last part to the last point that I mentioned on the permanent life insurance side. So this is one of the vehicles that you can use on your personal side to still take a loan against which we want to bring up. Um, when we talk about it again, it's just a way where it's a vehicle that if you have permanent life insurance, there's a cash value that you can take out a loan to. And it's not just for college. You can take a loan out against your policy for really any personal expense. But it's important to note that this is one of the few vehicles on call it the personal side that you can create that you can then take a loan out against yourself for an expense like college, etc. And why we bring up this part, and I'll when I get into the FAFSA, when they look at your financial situation, they're gonna look at income and assets of you, the as the parent or whoever may be supporting the child and the child. There's some assets that they count quote unquote against if you'll receive aid, and some that they don't count. Why we look at the permanent insurance and we bring up that you can take loans against it is the cash value generally, and again, it's going to depend situation to situation, is not considered an asset or the value is not considered as something you have access to via FAFSA, which would mean it's an asset where you do have a bucket of money here, but FAFSA is not counting it as necessarily something that would go against how much you're eligible for. Whether you use any of these different types of loans or vehicles really depends on your situation. We just like to make people aware of their options. So this is the fun word that everyone likes to bring up, FAFSA. It stands for the Free Application for Federal Student Aid. Essentially, what FAFSA looks at, or what it is when you're gearing up to get ready to send a family member to college, it's going to determine that individual's eligibility for federal financial aid, which means necessarily based off of their family income, assets, savings, all these different factors. They get a student aid index, which you see at the end part of the essay, student aid. The student aid index is a number that the government, based off of your FAFSA application, decides you can afford for college. Now, whether it's accurate or not, or feasible or not, it's more so a formula that the government has in place. So there's no necessarily arguing that. But it's just important as you're outside of when they're determining what FAFSA or student aid index you're going to get, that you acknowledge and you know what assets can quote unquote count against that, how to structure it efficiently, and then from here, FAFSA will determine by looking at all of that what you can afford, and if the cost of whatever colleges you're going to exceeds that, what aid will you may be eligible to receive. And the aid that you receive through FAFSA can come in multiple different forms, government loans, grants, and work study programs. I'll point out the two, like grants is money that you get and you don't have to pay back. So that's just, we're giving you X amount to make up for the gap. Whereas a loan is still something that you would pay back, but the government loans, as we mentioned, may have some favorable loan interest rates and all those things. So FAFSA is what you'll see. This is what, and we strongly encourage, no matter what your situation is, to apply. A lot of people won't apply because they think they're not eligible for aid. But what they don't realize is some schools might not give you merit-based aid, merit money, which is scholarships based off of education or extracurriculars, if you don't apply for FAFSA. So we tell anyone, no matter what your situation is, we strongly suggest that you fill out the FAFSA as soon as you can to when it opens, which is usually October of the fall of your child's junior year, family member's junior year. So when you look at FAFSA, you actually apply every year. I don't think some people realize that. It's not just the junior going into college year. You're going to continue to apply because the number that you can afford, and again, it depends on your situation, may fluctuate. So this is some of the information that you're going to need to provide when you apply. Your social security number and driver license number for the parent and the child, because we're looking at both the parent's information and the child's information. Two, federal tax returns and W-2 forms. This is again going to show any assets and income you may have coming in. Three, household income, including any untaxed income. So some people, they'll have a lot of questions based off of, say, we're in a divorce situation or a unique family situation. Um, this can get really nuanced in what income they're going to look at if you do have any of these situations. And I'm happy to talk through it more offline because it gets really granular depending on, who's on the hook for what. And a lot of divorce agreements don't necessarily have college drawn out, or if they do, the price of it is pretty outdated based off of the inflation I just showed you. So if you have questions around child support or any other income you may have coming in outside of your W-2, I'm happy to connect offline to help you better understand what that will look like. And then information on all banking accounts. Again, this will just show savings and things. Information's on investments. So this means real estate, any business accounts, whatever it may be. It's not just stock related assets. So they're really looking at what assets do you have throughout your whole portfolio. And then number of dependents will impact this. So what you'll see and why you fill out FAFSA every year is FAFSA for when you have one child in school might look different on what you're eligible for than when you have two children in school, because obviously that cost is doubling or increasing by whatever factor. But it's important just to familiarize yourself with what FAFSA is going to be looking at, and just understand what information and why they're going to be collecting that. So how does it work? Basically, first, the information that you submit, and I know I mentioned student aid index, EFC, these are basically just looking at, again, the number that looks at what aid your child is eligible for. So you can just think of either or, the terms aren't exact, but more so the purpose of FAFSA overall is to look at your family situation and determine what aid is your child eligible for, or depending on what college they go to. So it will depend on what school they go to as well. But overall, that number is going to be unified throughout, that you're on the hook for X amount, and then whatever aid that the college will give out on top of that or outside of it, it depends college per college or school per school, but that number will stay the same. So again, why do we fill out FAFSA? It's to see what we're eligible for, when it comes to the aid that we possibly can receive outside of what we may be able to, quote, like spend. So how does the FAFSA work? Essentially, you'll see like two different types of loans. You'll see two different types of loans, the pros and the cons, and we call them direct subsidized loans. So on the pros side, they're available for undergraduate students with financial needs. So after we go through this exercise, if it's found that your child is eligible, they may have access to some of these types of loans that have favorable terms to them. As I said, it's going to depend school per school. They'll determine the amount that you can borrow, and it's not going to be able to exceed that need. So what that means is, say we're looking at a Rutgers versus Penn State. Rutgers may give more money than Penn State or vice versa, depending on, you're going to look at what is the eligible amount that you can afford based off of FAFSA, what is the cost of tuition, how much they give to fill this gap is going to depend school versus school. There's no set amount that they have to do. Some give none, some are more generous. So I always suggest, and my team has the ability to look at each school to show you how generous each one is. But some people look away from some of the private schools are more expensive. Sometimes they're more generous. So I strongly suggest, whether you go through the exercise with a resource like us or whoever it may be, make sure you look into, typically what aid each school gives, because you might not even, give some schools a chance based off of their sticker price, when meanwhile, depending on where you fell FAFSA wise, they may give you more money and it may make more sense than a state school that you traditionally would think is more affordable. And then, as you'll see here, one of the pros is the U.S. Department of Education will pay interest or quote unquote freeze while you're in school. So there are some benefits to them. On the flip side, they are available to the undergraduate and graduate students, even if they aren't eligible for financial need. That amount that they have access to just might change depending on where they fall. So again, I know I'm kind of speaking in the gray here. It's important to go through the FAFSA, figure out your student aid index, what you're going to be on the hook for cost wise, what aid you're eligible for. But again, the school will look at what amount you have access to, and the difference here is if you don't have the requirement but you still utilize these loans, you're going to be responsible for the interest while you're in school. It won't be subsidized. So it's just important to know that you have access to this type of loan, but what are the differences on either way? Again, these are some other grants and things that you can get through FAFSA without getting into the weeds of it. What's really important, what I want to drive home, is just filling it out. Once you fill it out, you'll know if you have access to the Pell Grant. Is a grant one of them that you can get and you don't have to pay back depending on where you fall FAFSA wise? And then two, there's also work study programs that a lot of students get offered where you're given the opportunity to apply for a job on campus, and then the payments intended to help you pay college expenses. So it's kind of you're putting in the work with XYZ job, and then they help you pay the expenses of college. Long story short, there's a lot of options and opportunities, but you just want to fill out the FAFSA and then do your research or work with someone who works in this space to help you understand what you have access to. Um, and then there's some other things that you can do to decrease annual cost or use quote unquote other people's money. I want to touch on the first one on the middle scholarships. Some people think you got to be a junior, whatever it may be, to start utilizing these. You can start as early as middle school, elementary school, and there are scholarships for anyone. There is a scholarship for a news anchor that did one because he was an average student, but he ended up making it big on the news where you have to be a C average student that goes to Ball State and you get that scholarship. And I say that people chuckle. There are scholarships for unique prom dresses, all these different things. So, we have so much access on the internet. I strongly suggest once you figure out maybe interest or whatever it may be, it could be a couple $100s, couple $1,000. It all makes a dent. Look into scholarships, even if you don't think based off of just quote unquote academics, you may be eligible. Two, degree in the three, I think this kind of relates to some of the shorter programs or graduate programs that are out there where you may be an undergrad for 3 years and then you accelerate into their graduate program like law school and some others. So I just suggest if you have a student that's looking to do an extended program, what this is suggesting is look at what the overall cost will look like because if you have some of these accelerated programs, again, the school might be more expensive, but you might save money based off of the lesser years in education itself. Credit transfer and residency change, there's a lot of regulations around these. It's not as simple as, some people will be like, I'm going to move to Florida and go to college there. There's a lot of timing that goes into it. You need to be a resident there for a certain amount of years. You need to have licenses set up and all these different things. I can't speak to every single state, but the regulations are going to change. So again, that's where if you have questions on a certain state where your child or family member is looking, I suggest reaching out offline and we can look at what the regulation looks there to do that. And then credit transfer is more so looking at your credit, whether it be your score to apply and be able to receive these loans, or on the flip side, looking at different credit options to take loans out for paying. You just always may be able to use a different vehicle to get loans or whatever it may be at a lower rate. So again, there's a lot of different options. It's really important to you got to start with the fastest, see what you're eligible for, and then there's all these different ways to decrease your annual cost once you get to that time. So just to review what we went through, because I know that was a lot. One, we want to look at the cost of schools. This says preferred schools. again, you can start saving or preparing for the cost of college even at an early age. The earlier you start with any goal, the better, and it goes the same for college. But don't be disinterested or discouraged if, say, your child's even about to go to college next year or in college. There's still plenty of benefits to starting to structure the correct savings program or plan for college tuition. So we say research the cost of where you're at, whether you need to project it out 18 years or it's next year. Figure out what that cost is and start creating measurable goals against it. Two, set a savings goal. I think it's really important if you want to support part of college or your child does, whatever it may be, to have a set numerical goal that you're going to be reaching towards because you can't track your progress to anything if it's not quantitative and you can't measure against it. Consider the funding rule of the thirds again. That's kind of high level, but what this is referring to is having three buckets of money to pay for college. One is past, which would be savings. So, leading up to the time of college or while in college, that money that you put away in the past in the savings bucket to pay for part of college. Two is income. So having college set as a monthly expense and utilizing or putting away X amount of income to pay college currently. And then three is that loan bucket for a third or whatever portion where you want to research the loans, research the costs, make sure you're not taking out too much and have a clear plan where you can leverage the loans so you don't put yourself in a tight cash flow situation at the time of college, but you are paying it down the road. Lastly, take advantage of other people's money. Apply for the FAFSA. I always say there's so many people that don't apply and apply early. That's the only way you're going to know what you have access to. And don't start looking at scholarships the month before college. You have plenty of years to look into them. We have great access to counselors at high schools who have a lot of resources. We work with a lot of those people with some of our clients and families. So go to them for information. Go online. There's plenty of information out there to what scholarships you may have access to. And then the last one is seek guidance. This can go for a lot of different ways. One, I always say one of the underutilized tools is the counselors in our schools. They not only will help you look at all these different pieces that I discussed from the FAFSA, but will also help you and your child figure out based on their personality, what majors to look at. Based off of that, what colleges are most efficient based on your majors, all these different things. And they're there in the school with you. So I always say, use what you have access to that's not additional. Two, there's a lot of different professionals you can look at from the college prep side, which I always suggest if that's an option. You can look at your counselor should have some connections there to local organizations. And then three, a lot of what we talked about today was on the financial planning side. Again, with all these workshops, we always say we're happy to connect with those on an individual basis because what you're going to be eligible on the financial aid side is going to be very specific to you. Same with the merit side. And then three, how you can break up saving for college while not derailing all the rest of, your other goals, retirement, house, etc., is going to be personalized to your situation. So if this left you with some curiosity or information where you're not sure how to move forward with, we're always happy on that side to help you put a plan in place and start becoming familiar with some things you can do ahead of time. So that leaves our third part of the series to an end on the college planning side. Again, with all of our workshops, we always offer a 30 minutes, no necessarily commitment with us, but to answer any specific questions. I know the college topic can stir up a lot of things. What is the cost going to be for me? What do these schools look like? We have softwares that we can utilize to help you figure out what your student aid index will be, what you'll be on the hook for, how to break it up between loans and all of that. So, if anything, if this left you being curious, I always want to say it's meant to have curiosity drive action. So if we can help you do that, we offer this to everyone. We're happy to do so. And I'll throw the link in the chat if you want to use that instead of the QR code. But with that, I thank everyone. And again, I know college can be overwhelming. There are a lot of resources if you take any theme from this workshop, how to utilize them. We're here to help. There's so many resources with your schools and online. So I just say, again, take the curiosity and have it lead to action because there is a lot out there for you to utilize to make this milestone easier than you think.